Thank you guys for joining. So my name is Mark Lamonica. I look after the individual investor team for Morningstar here in Australia. And today we're going to talk about emerging markets. So hopefully an interesting topic. But we have to go through some housekeeping items first. So number one, anything you hear today is general advice. I can't offer you any personal advice. If you're over in New Zealand and you would like to get a copy of our FAP, you can go to our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to go speak to a financial advisor if you're looking for personal advice. So yeah, as I said, emerging markets today, even though I can't offer personal advice, I still like questions because it makes it more exciting for me. So if you have any questions, you can pop them into the Q&A on Zoom or into the chat. If you're on Instagram Live or Facebook Live, just send through those questions on those platforms and they get relayed to me. All right, so let's talk about emerging markets. Okay, so we're going to cover a couple different things today, but just to provide a little bit of an overview of emerging markets, the world is divided up into developed markets and emerging markets. So when we are looking at investing internationally, one option we of course have is to invest in emerging markets, but there is a couple of specifics around emerging markets that you should know as an investor in them. So number one, I'll go through these bullet points. So uncorrelated returns, but highly volatile. So what does that mean? We'll sort of break down those different terms. So uncorrelated returns means that correlation, of course, a perfect correlation means that the returns would be the same in two different assets. So uncorrelated returns means that based on other investments in your portfolio, emerging markets generally will perform differently. So we'll go back and go through a little bit of history. Highly volatile, which we'll also talk about, that just means that the share price bounces around a lot. So the index levels or the individual share prices. We'll talk about why that happens. All right, so let's go back and go through a little bit of a history. So emerging market investing really took off in the 2000s. Early 2000s, and investors were seeing countries like China opening up and growing very quickly and wanted to get a piece of that. So if we go back and look at decades, so between 2000 and 2009, the MSCI Emerging Markets Index, which we'll refer to a lot, but sort of the main emerging markets index that people use, it had a return, an annualized return of 9.78%. And if we compare that during that same decade, so the first decade in the 2000s, the S&P 500 in the US returned negative 0.95% a year. So emerging markets obviously significantly outperformed. And the MSCI World ex-US, so these are developed market countries, not including the US, had a average annual return of 1.62%. So in that first decade, remember, a lot of stuff happened in that decade. So at the beginning, we had the dot-com bubble burst. And then, of course, we had the GFC occur. So a lot of stuff happened, but emerging markets significantly outperformed all developed markets. Then if we go and we look at that next decade, the second decade in the 2000s, so 2010 through 2019, emerging markets index returned an average of 3.68% a year. The world, excluding the US, came in at 5.32% a year, and the US had 13.56% a year. So sort of totally opposite in that next decade. So remember, we basically swapped places. World ex-US still sat in the middle, but US significantly has outperformed any other market or most other markets in that second decade and have not done too well with emerging markets. So that's that first piece, uncorrelated returns. So of course, if you had emerging market exposure in both those cases, first decade of the 2000s, very good thing because you're getting high returns. Second decade, bad thing because you're getting low returns. But either way, it is uncorrelated to your portfolio. And we'll talk in a second why you would want to do that. But it's very, very volatile. So if we go back and we look at a period between 1988 and 2019, so emerging market stocks outperform U.S. stocks by 34 percentage points or more 4 different times during that period and underperformed US stocks by that same magnitude 4 times during that time period. So these are big swings and significantly different, as I said, from developed market stocks. Now, why do you want uncorrelated assets in your portfolio? Well, one of the reasons you want to do that is because it's going to lower the volatility of your overall portfolio. So in that case, it is for people who are worried about volatility, so worried about prices bouncing around. That can be a very good thing. But remember, volatility is really something that we should mostly be worried about during certain times in our life. So as we're kind of moving into retirement and early in retirement, because we're trying to deal with sequencing risk. All right. The other thing to know about emerging markets is we kind of lump them all together. So we're lumping a lot of different countries together. And there is no way, and this is important, there is no way to get out of being an emerging market country in terms from an investing perspective. So there's no way that you graduate into developed markets from an investing perspective. So the way we've divided up the world, it is what it is at this point. So what you can see is I put a number of, actually Indonesia's overtaken Malaysia. What I've done is I put in the top countries in an emerging market index in this MSCI emerging market index, which we'll look at in a second. And I put the per capita income in them in US dollars. Per capita GDP in US dollars. So what you can see on here is there are huge differences between some of these countries, right? If we look at Taiwan and South Korea, for example, a lot higher per capita GDP than, a number of different countries, but certainly if we're comparing it to India and Brazil and South Africa, these are very different countries with very different economic profiles, but we have just lumped them all together. So it's something to be aware of, that when we say emerging market investing, we're talking about very different countries. And you can see we put Australia, and this is in US dollars. Remember, we put Australia down here at the bottom just as a reference point. But that's something to be aware of, that, we're doing investing in Taiwan, South Korea, very developed countries, is a lot different than investing in India, which is still developing. The other thing is valuation levels. So valuation levels are very different in emerging market countries. So when we're looking at something like a price to earnings ratio, so that is simply dividing, price earnings. So there you go. But what we're looking, basically how much we're willing to pay as investors for a dollar of earnings. So it's one of these relative valuation techniques that people use a lot. And I've said this multiple times on here, you can't really use a figure like that without context. So emerging markets are cheaper, and what we'll explore today is, should they be cheaper? All right. So are they a lot riskier than investing in developed markets, for example? Should they be cheaper? But there are a lot of people that say emerging markets are a great opportunity now. So I talk about Jeremy Grantham a lot on here. He's an example of somebody that thinks emerging markets are a great opportunity. This last bullet point, which we'll also go through today, they are less efficient than developed markets. So let's talk about what that means. When we talk about efficiency in investing, we are talking about how much price reflects value. So the closer that is together, the more efficient we would say a market is. So in this case, they are less efficient. That means we think that there's bigger deviations between price and value. And the implication of this is that humans should do a better job actively managing portfolios. And we'll talk about that today. So less efficient markets are markets where you might want to consider using active managers rather than passive index investing. So we'll go through a little bit of that. But first, we do have a question. Yeah, so Lisa, good question. Hopefully we cover this. At what point does a country become first world categorized? Does it have a shrinking or growing effect on those countries remaining in a third world equity class? Yeah. So that's the very strange thing about investing. You can't really graduate out of an emerging market, because basically what they've done is they sort of set these indexes and set countries in this sort of developed side of things versus emerging markets. There are a lot of developed markets that you could argue probably shouldn't be, but that's just kind of the way things work from an investing standpoint. So you got to separate investing from the way we would think about countries in any other way, from a development standpoint. Yeah, so Phil's saying, yeah, China used to be an emerging market, but is that description valid now? Yeah, I mean, listen, China is an emerging market in terms of investing. Now, whether it's an emerging market in any other way, yeah, I mean, that's sort of up to you to judge. But as we'll see in a second, China makes up an enormous part of emerging market indexes. So something to consider. All right. So just wanted to look at the last 5 years performance. So I talked obviously about sort of longer term, decade by decade performance trends. So we've got 3 different ETFs on here, and 2 of which we're going to spend some time talking about today. So first ETF, this IEM, that is an emerging market index. So that tracks the MSCI Emerging Market Index, which we'll spend some time talking about today. So you see past 5 years, up 55%. This VGS is tracking a MSCI Global Index of developed market countries. You can see significantly outperforming emerging markets, so up 117% in the last 5 years. And then VAS is our old Vanguard ETF that tracks the local market. So you can see big outperformance, and this outperformance in the past 5 years of this MSCI index, the Global Developed Market Index, really is because of the U.S. The U.S. is a huge part of that and has dragged it up because the U.S. has done very well lately compared to other markets. But yeah, you can see where we're at from an emerging market standpoint. All right, so let's keep it going. Okay, so let's look at these indexes, just so we can get an idea of what we're actually investing in. So these are 2 of the ETFs we're talking about. So this Vanguard MSCI International ETF, this VGS, you can see dominated by the US. So when you're investing in these indexes, a lot of it's going into American stocks. So something to remember. There are a lot of indexes that remove the US as well. So if you want more global exposure and developed market indexes, look for one of those indexes or ETFs or funds, if that's what you're trying to do, let's say ex-US, because they've removed that. But we're going to spend some time looking at the emerging markets ETF. So not as much domination as the US, but China makes up a huge part of the emerging markets ETF. And something to note is that China has not done well traditionally from an investing standpoint. So, and there's probably a lot of reasons for this, but China has done very well if we go back and look at just GDP growth. So China has been growing significantly faster than most countries, certainly all developed countries in the world. But China has not done well from an investment standpoint. So it's something to consider. And we can talk about China more later since people have generally have a lot of questions of it. But yeah, China just from an investment standpoint has not done well. So it's something to remember. A lot of that kind of underperformance that we see is over the long term in emerging markets is kind of related to China. But yeah, you can see the other countries on here and this is the majority, almost 90% are in the top 10. And you can see just from an allocation perspective where we're at with each one of those. Yeah, so Paul's got a really good question, which hopefully we'll get to as we're going down here. He's saying emerging market return doesn't seem to reflect risk. I guess global exposure and diversity is the main reason to invest. Yeah, listen, it's interesting. As investors, what we're trying to do is obviously we're trying to exchange risk, and the way that risk is classified is volatility by the investment industry. That may not be in actuality a risk that you face if you're a long-term investor, but that's how we talk about it in the industry. So what we're trying to do is exchange, of course, risk for return. So the more risk we take on, the more return we should get. If we are not getting that, then why are we taking on the risk, right? So the very simple comparison we can do is, shares versus cash. Right, we've got no risk other than obviously inflation risk. And anyone who read the paper this morning sees we had a huge jump in inflation in the U.S., which the markets did not like. But you have no risk putting your money in the bank, all right? As long as you don't have too much. The bank obviously guarantees it. The government backs the bank up, so that's no risk, and you get no return. Shares, you have volatility, so your value is going to bounce around. But yeah, I kind of agree with Paul that if we go back and look at emerging markets as a whole, the returns haven't really made up for that volatility. Now, why would you want to invest in emerging markets then? Well, I mean, that's obviously historic. We need to look at what's going forward. But yeah, I'd say it hasn't been a great investment if we go back and look over the last 20, 25 years, certainly over the 5 years on here. Right? Like, why would we take this bet? Underperforming Australia, underperforming the global indexes, and you're getting a lot more volatility. So it hasn't been a great investment. But once again, as investors, we can only look forward. All right. The other thing we should just talk about, if we look at these indexes, what are some of these companies that make up these indexes? So Taiwan Semiconductor is kind of like the rock star of emerging markets, has done very, very well. But a couple of these other companies, you can see some of these Chinese companies, Tencent, Alibaba, have not done well. Once again, we've had issues in China, particularly recently, where Chinese shares have not done well. So yeah, something to consider as an emerging market investor. All right, so let's talk about different ways you can access emerging markets. So it is relatively difficult to find. I know there are certainly exceptions of this, but to easily access direct equities in a lot of these countries. So it is difficult to do that. So a lot of people, of course, turn to managed products. Let somebody else do that. So remember, and we'll talk about this on the next slide, when we look at different asset classes, and when you're an investor, what you want to do is you want to look at all the different asset classes you want to get exposure to. So whether that's developed market equity, emerging market equity, listed property, infrastructure, et cetera. And we want to look at the characteristics of each one of those asset classes before we make a decision about how we're going to access it from an active or passive perspective. So what we've got here, and these are our analyst ratings. So we've got a couple ETFs. So the one I've been showing is this iShares MSCI Emerging Market ETF, the ticker symbol IEM. Vanguard's got a product as well, VGE. Both of these receive a bronze rating from our analysts. So remember, our manager research team rates funds, ETFs, and LICs. Uses a consistent process to do that. And our medalist ratings, gold, silver, bronze, are ones that we believe are good opportunities. Neutral means we're neutral. And then negative, we think you should not actively go out and avoid that ETF or fund. But as I said, emerging markets, there is the opportunity to potentially use active management there. We think there's a good opportunity there, and we'll talk about why in a second. But you can see some of our highest rated active funds. So of course, this Capital Group New World, just a hedged and unhedged version. So hedged is, of course, removing currency risk. One thing I will say about emerging market countries is there's a lot more volatility in the currencies as well. So not only do you get volatility in the actual companies, you get volatility in the currency. So if you want to remove that, you can go ahead and hedge, and then you see some of our other top rated ones. So let's talk a little bit about efficiency and these markets, and why we think emerging markets are less efficient. Okay, so once again, as I said, efficiency represents value and price. So the less efficient market is, the more deviations there are between the value of a share and the price that it's trading for. And the bigger those deviations are, the more opportunity we have to actively go out there and pick the right shares and outperform the index. So if a market is very efficient and price and value are in lockstep, then of course it's going to be very difficult for us to beat the index because those deviations aren't as great. So what I did is I took this page from the Morningstar Active Passive Barometer report, because the problem with efficiency is there is no way to, on an absolute basis, know what the value of any company is. So obviously, a lot of people try to do that themselves. A lot of analysts do that, but it is it's an art form, right? So, and it is an estimate of what's happening in the future. But one way we can measure efficiency is we can go back and see how many active managers outperform the benchmark. So the idea here is that the higher the percentage of active managers that outperform a benchmark, the less efficient that market is, because there's obviously opportunities for them to go out there and find undervalued securities or countries. So this is that active passive barometer report. So we put this out twice a year, and we go back and we look at it, as you can see, over different time periods, but we're trying to look at 10-year, what is the percentage of active funds that outperformed the passive index? So high cost, we of course want to avoid no matter what. So we don't really pay too much attention to that. But you can see diversified emerging markets, 58.3. So if we go down this list, that is the second highest rate of outperformance. So that means 58% of active managers managed to beat the index, which is very good. So this is why we think that there are opportunities to use active management in emerging markets. So the only one that's higher is high yield bonds, so junk bonds is the only one that's actually higher, which is interesting. Now, why can emerging markets be less efficient, and why can people outperform? Well, I think it's a couple different things. Number one, the more people that pay attention to something, the less likely it is that there's going to be large deviations between price and value. So if you look at large cap developed market stocks, there's a lot of people paying attention. So a lot of investors, a lot of professional investors, a lot of analysts paying attention to that market. Emerging markets is different. Number one, they're just not as popular to invest in. Number two, there are certain investors who can't invest in emerging markets. So certain institutional investors that, because of risk mandates that they have, can't invest in emerging markets. So that's, and they're hard to access, right? So once again, if I want, sitting in Australia, if I want to go trade US shares, there are a ton of different ways I can do it. Basically, every broker in Australia will let you trade on exchanges like the US, UK, maybe some of Europe, but it's very difficult for me to go access directly trading in Mexico or Indonesia, right? So there's just less attention paid to them, much like small cap stocks and micro cap stocks. Same thing. There are structural impediments, and a lot of people just don't invest in that space, which means that is where there are opportunities for active management. All right, we've got a I've got a question from Instagram. This is good. All right, so we've got a message from June saying, "What do you think of the new crypto ETF that's just been launched?" All right, a little bit of a different topic. So I'll try to answer this one quickly. If there are other questions on emerging markets, or I guess anything, just send those through. But okay, so the new crypto ETF. So people that have been paying attention, there have been a lot of moves in sort of crypto ETFs globally. So the first thing that happened, and we'll get to Australia because that's what I assume that you're referring to. The first thing that happened is in October, the US launched its first sort of, and we'll talk about some of the specifics, the first ETF that has exposure to the price of Bitcoin. And the US regulators approving that have now led to ASIC approving it in Australia. Now, that product has not been launched yet, although a couple people, Van Eck, beta shares, are racing to get one out. So we don't have sort of a direct, and I'll talk about how that works in a second, ETF linked to crypto right now. What has launched is two different ETFs. So a Cosmos ETF and then a beta shares one that launched this week that both have exposure to companies that are in the cryptocurrency space. So the first thing is you are not buying crypto. You're not even buying anything that resembles crypto. You're just buying companies that have something to do with it. So this is, for all intents and purposes, a thematic ETF. The theme, of course, is crypto. So depending upon the different, we'll use the term index loosely, but depending upon the index that they track, it is tracking Bitcoin miners, for example, things like that. Yeah, I mean, I guess I would say about it, I'm not wild about any of these ETFs, and this Van Eck, the beta shares product that was launched this week got a ton of money. So it set a record for the largest inflow into an ETF in Australia. The US Bitcoin one that launched in October also set a record, got close to $1 billion in the first day. But yeah, I mean, I guess my attitude is, and I'm not someone you should listen to about Bitcoin, but my attitude is that if you think Bitcoin is the next big thing, just go buy Bitcoin. So I guess I don't really understand if you think that this is going to be a great investment, just go buy the Bitcoin, right? Like, don't buy an ETF that then tracks miners who have some relation, obviously, to Bitcoin. Just go buy it yourself, right? Like, if it was easy to do, I would never recommend you go buy an oil company. If you are dead set on thinking that oil is going to go up in price, just go buy the oil, right? Now, you can't do that, right? You can't fill your apartment with oil, but Bitcoin's easy and it's easy to hold. So why don't you just go buy Bitcoin instead of these companies that may have some correlation to Bitcoin, but not a direct correlation? It'd be better just to go buy it. Yeah, that's my opinion on the crypto ETF. Yeah, Paul saying emerging markets seem to have little going for it other than to extract high fees for fund managers. Yeah. I mean, maybe. I think the thing about emerging markets is, once again, much like a developed market index, driven a lot by China. And so the big question, of course, is what's happening in China, and sort of that decision as an active manager on how much of your portfolio you're going to put in China is going to be the big driver. And I think that, and I've talked about this before, I think there are a lot of things that are concerning about investing in China. Just that, whether it's good or bad, no history of a shareholder aligned government, I guess I would say, but whether that's good or bad, that's kind of China. All right, so we got a question from Nigel from Facebook. He's saying shortage of microchips. How will that affect the market? Yeah, so it's interesting. There's obviously, we saw this big jump in U.S. inflation again, and to the point where Biden came out and actually started talking about it, talking about, quote unquote, doing something about it. I don't know what he's going to do about it. But one of the things that's happened is we have seen since sort of emerging out of COVID, we've had all these kind of supply problems. And one of them is microchips. So, there is a shortage of microchips that's affecting everything. So even cars, right? We've seen this huge jump in used cars, the price of used cars, because the supply of new cars is down because they can't find enough microchips to make cars at the level of production that they need. So yeah, it's hard to say directly, Nigel, how that is going to impact the market. I think a lot of people have decided it's a good time to buy microchip manufacturers. I don't really understand that. I mean, I don't think that there's going to be this giant change overall in long-term demand for microchips based on what's happening. There's just sort of this supply glut right now, and they'll get back to a point where they are building, when they are making enough microchips. But yeah, it's hard to say. I think sort of the bigger question is, what impact is inflation going to have on the market? traditionally it's not been good, but this is just one of many shortages with supplies. So Phil's saying, is it fair to say that Bitcoin is soaking up a lot of potential emerging market investments? Yeah, I mean, maybe. It's hard to say. I think that if we look at emerging market investing, it's not that popular. You don't really hear about it much. So you certainly heard about it in the early 2000s, and they had a very, very good decade. You just haven't heard about it much, I think, because of underperformance. So the question is, going back and looking at those valuation levels, do you think those valuation levels are compelling enough to go into emerging markets? So there are a lot of kind of old school value managers that would say yes, but we just have to be cognizant of the risks. So obviously, sort of greater currency risks, risk in a lot of countries potentially having less stable institutions, which can affect shareholder returns, certainly. Yeah, I mean, I can't say that emerging markets are at the top of my list for investing. I think sort of the parallel, Phil, right, between Bitcoin and emerging markets is, very similar, right? High volatility, and would probably be on the more speculative side of most portfolios. So maybe that's something that people are shifting their bets over to something like Bitcoin. All right. So Paul's saying valuation of Bitcoin, anything between $1 and $1 million, equally justified, no real asset as a utility currency. Valuation doesn't really matter. Forget the mania. Yeah. I mean, listen, it was funny. I was, Will's here, not in the room, but on the other side, I was talking to another guy on my team about Bitcoin today. So people are interested in it. Yeah, I mean, I think with Bitcoin, I'm not the one you should ask. I think the question is how much we'll continue to use, right? To be used. So I think that's probably a big thing for it. All right. We seem to be out of questions, which is good. So yeah, another quick one today. If anybody does have any questions at any other time, you can, of course, email me. I've got a bunch of emails I need to get back to, which I will do today. But anyway, thank you guys very much for joining. I appreciate it. We'll be back here on Tuesday doing this all over again. So I hope everyone has a good day and a good weekend. Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.